everyone. Welcome to this session on input tax credit under GST. It is one of the most important concepts in GST. If you understand ITC properly, I assure you that you understand almost 50% of GST. Today we are discussing section 16 of the CGST Act. It lays down the eligibility and conditions for claiming ITC. So throughout this presentation, we will answer various questions such as why is ITC? Why is ITC considered the backbone of GST? What are the 6 mandatory conditions to be fulfilled for claiming ITC? Then what is the 180-day rule? And what is the time limit for claiming ITC? And last but not the least, why is ITC often rejected by the department? By the end of this video, you will have a clear practical understanding of what is section 16. Let us move to the topic. Let us first understand why GST was introduced and why ITC concept was introduced in GST. Let me give you an example. Suppose a manufacturer purchases raw materials by paying GST. If that GST cannot be claimed as credit, it becomes part of the cost of the product. Again, GST is charged on the finished product which is manufactured using the input. This creates a burden called a tax on tax, and this effect is called popularly as cascading effect, as most of you know. GST removes this problem through the ITC scheme. That is, a tax paid on purchases become available as credit and is adjusted against GST payable on supply. Therefore, GST taxes only the value added at each stage of the supply chain. So this reduces the cost of the business, improves cash flow to the business, and makes Indian products more and more competitive. This is why ITC is called the backbone of GST. Now let us understand the structure of section 16. That is very important for a better understanding of the scheme of ITC. Section 16 has 4 important parts. 16 subsection 1. It grants the basic eligibility to claim ITC, whether the concerned taxpayer is eligible to claim ITC or not. Next comes subsection 2 of section 16. This is exactly the heart of the GST provisions because it prescribes 6 mandatory conditions. So then we have important provisos, that is part of the clause. These include what is a situation when goods are received in lots or installments, the very famous 180-day payment rule, and re-availment of credit, etc. Then comes section 16 subsection 3. It prevents double benefit by prohibiting both the depreciation on GST component and ITC, the dual benefit. Finally, subsection 4, which prescribes the time limit for claiming ITC. So if you remember this structure, section 16 becomes very, very easy to understand. These are the four important provisos. Have a look at it. Now let us understand what are the basic eligibility for claiming ITC. Let me show you the content of the slide first so that you can just consult. Now I will explain. The first requirement is that the claimant must be a registered person. Very, very important. The person has to be registered under GST provisions. Second is the credit should relate to goods or services, because GST is on tax on good supply of goods or service or both. And thirdly, these goods or services should be used or intended to be used in the course or furtherance of use. So actual usage is not necessary. At least the recipient should have an intention to use the same in the course or in furtherance of his business. So there are so many conditions. Once these conditions are satisfied, the ITC is credited to his electronic credit ledger. So three ledgers are available. The ITC which is claimed can be seen in the electronic credit ledger by logging into the GST portal. Now let us look at a few examples. Suppose if you purchase raw materials, office computers, office rent or legal services for your business, ITC is generally available because all these are going to be used for a furtherance of your business. But if you purchase household furniture for personal use or incur some expenses unrelated to your business, ITC is not available. That is very important. So the key question should always be, is this expenditure connected with my business? Ask it. And if the answer to your question is yes, then I would suggest you proceed to examine the remaining conditions under section 16, subsection 2. Now let us understand the famous 180-day rule. Let me first show all the contents. So one condition often forgotten by taxpayers is the 180-day payment rule. So claiming ITC alone is not sufficient. Why? Or what? You must pay the supplier the value of supply together with the GST within 180 days from the invoice date. That is the outer time limit before which the recipient has to make the full payment with the invoice to the supplier. Then what is the consequence if you don't make that payment? If the payment is not made within the 180 days threshold, the ITC already claimed, if claimed, has to be reversed along with the applicable interest, which is payable under section 50. You can make the payment later, only interest will get levied. So however, once payment is eventually made by the recipient, the ITC can be re-availed. That's a benefit. So it is not a punitive action. This is to compel the recipient to make the payment to the supplier on time such that the supplier can deposit that amount to the government's revenue. So please remember that this rule doesn't apply to reverse charge supplies. In reverse charge supplies, as you know, the liability to pay GST and value is upon the recipient. That's a separate mechanism, and we will discuss the concept in another video. So many taxpayers lost credit simply because they ignore this payment condition. So do not forget it. Keep this in mind. 180 the rule. So always monitor outstanding creditors. That is my suggestion. See, subsection 3 of section 16 says that The taxpayer cannot claim double benefit, benefit by way of claim of ITC and also claim of depreciation. Let us see what it says. The provision is very simple. Let me show the chart and all so that you can understand it better. Suppose you purchase a machinery. As you know, machinery is going to be capitalized. It is called a capital goods under the GST provisions. So the GST paid on this capital good, that is machine, can be treated in two different ways. Accountants know that. Option 1, you can claim ITC credit under GST. And in option 2, you can add the GST amount to the cost of the machine and claim depreciation as per the accounting policies or as per the income tax act provisions completely. You can choose either of these two. What is option 1? Option 1 is claim ITC on the entire capital goods value as ITC. Or you can add the ITC you paid when you purchase a capital goods to the cost of purchase and capitalize it, and later you can claim ITC on the entire amount on the capital goods. So the law says you must choose only one option, so no double benefit. You can, that is, you cannot claim both ITC and the depreciation on the GST portion. So therefore, remember, one simple sentence, one GST amount, one tax benefit only. This is exactly the essence of section 16, subsection 3. Practically very, very important point. Now, can the availment of ITC be deferred forever? The answer is big no. So this slide tells you the outer time limit before which the taxpayer has to claim the ITC. If he doesn't claim the ITC, then the input tax will lapse. So accordingly, many taxpayers satisfy every condition but still lose ITC because they miss the time limit. Then what is the time limit? That is given in section 16, subsection 4. So it says that registered person is not entitled to avail ITC on an invoice or a debit note after earlier of 30th November following the end of the relevant financial year or the date of furnishing of the annual return. As you know, annual return has to be filed on or before 31st December of the year following. So let us take an example. Suppose an invoice is dated 15th July 2025. So it is relating to financial year 25-26, as you know. So this can normally be claimed up to what period? That is 30th November 2026. So provided the registered person will be filing his annual return for the financial year 25-26 only before December 31st, 2026. So if he happens to furnish the annual return before November 30th, then that date will be the outer time limit before which the registered person has to claim his ITC. Please remember this date. Any delay on the part of the recipient to claim ITC paid on purchases, inward supplies, he will lose the eligibility. Therefore, businesses should handle and reconcile their purchases together with their entries in GST or 2B every month and never postpone ITC verification until the end of the year. That means the delayed reconciliation often results in permanent loss of credit. I underline that. This is a warning. Now, a lot of cases come to my side. There are many cases in which ITC has been rejected by the department, by the officers. We cannot blame them. There are some common reasons for ITC rejection. I just wanted to give you a practical checklist. So then why is it rejected? Now let us now look at the most common reasons. So one is no GST registration, no valid invoice, tax invoice, or invoice is not reflected in GST or 2B of the recipient, or goods or services are not received, or tax not paid by the supplier. So GST or 3B not filed, or non-payment of the invoice amount along with the GST within 180 days, or a depreciation claimed on the GST component, or a claim made after the statutory time limit, or blocked credits under section 17 subsection 5. There are many reasons. So then my suggestion to avoid these problems, always follow a compliance checklist. Let me give you the checklist. Pay suppliers within 180 days. File your GST or 3B on time. Claim ITC before the deadline. And always verify blocked credits. So we have a golden rule. No invoice, no receipt, no GST or 2B, no return, sorry, no ITC. I hope you understood this. Very important. Now let us conclude. Before we conclude, let us quickly revise 6 mandatory conditions under section 16 subsection 2. I just wanted to convey this. First, possess a valid tax invoice or a debit note are the relevant records as permitted by the GST Act and rules. Second, ensure that the supplier uploads the invoice and it appears in your GSTR 2B. And thirdly, receive the goods or service at least on a deemed basis. Fourthly, ensure the credit is not restricted under section 38. Fifthly, ensure that the supplier has paid the tax to the government. You have to check it up with the supplier. And lastly, file your GSTR 3B. That is a most important thing. You have to file your GSTR 3B to claim and use ITC to set off your output GST liability. So importantly, remember 3 more important points. You may please make the payment within 180 days to the supplier. The 180 days should start from the date of invoice issued by the supplier. Do not claim both ITC and depreciation, either one. No double benefit. Claim ITC within the statutory time limit. I told you November 30th of the following year or date of filing of annual return, whichever is earlier. And finally, always verify whether the credit is blocked under section 17(5). So I will conclude with a one important sentence and advice to you. ITC is a statutory benefit. It is not an automatic right. It is available only when every condition prescribed under GST law is satisfied. So thank you for watching. See, if you found this presentation useful, please like, share and subscribe to the channel for more practical learning sessions. Thank you.